makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Well, risk sentiment dampened after Fed officials warned that interest rates should stay higher for longer, causing another record-breaking stock rally. Now, Chinese retail sales show their slowest rate of growth in a year, while Beijing gives its ailing property sector a boost, easing mortgage lending. Plus, Jamie Dimon tells us he's still more worried about inflation than markets appear to be. We'll have more from our interview with the JP Morgan chief executive. Now, also coming up, some big interviews on politics and, of course, on the economy. We'll be speaking to the president of Georgia ahead of the Eurogroup. And, of course, we'll also talk to leading wealth manager Daniel Pinto. Now, let's take a look. First thing is first. Let's look at the European markets map. Again, we've had a bit of volatility, actually, in the week so far. Now, they did retreat a lot of these stocks for a second day. Again, there's been some dialed-down bets for Federal Reserve policy easing, and that seems to be weighing in on sentiment. A couple of other things we need to watch out for. Richemont actually has a new chief executive officer, up more than 6%. And then if you look at some of the biggest banks, again, they're a little bit higher after gaining already 21% this year. Now, to talk about the markets, to talk about the Fed, to talk about inflation and everything in between, let's bring in Patrick Armstrong. He's Chief Investment Officer at Plurimi. Well, Patrick, so good to speak to you. We've had a good week, yep, right, by certain metrics, but at the same time, at CPI prints means that the markets are now expecting the Fed to kind of, not panic. Is that right?
Inflation's too high. Growth is too strong. The employment backdrop is too strong for the Fed to even be considering cuts in the next few months. So as the summer plays out, the employment backdrop may weaken. There's cracks starting to emerge a little bit, but it's still a very robust employment market. Wage growth outstripping inflation. Anyone who wants to work has a job. There's 1.4 job openings for every unemployed person. So it wouldn't make sense to be cutting, and just markets show you there's a lot of liquidity slushing around in markets. You can just see movements, meme stocks, things like that. So it's not surprising the Fed's not talking about cutting. Inflation, I think, is going to be sticky, persistent, and it's what's going to make the debt dynamics work is nominal economic growth. Real economic growth will be there, but nominal growth is what makes debt to GDP ratios start to work. So you need inflation to be part of the solution even.
Yeah, and Patrick, we also spoke to Jamie Dimon, and this is what he had to say about inflation and possible market correction.
Surprise would be higher rates because inflation didn't go down. That inflation has been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise.
Are you expecting a correction in certain parts of the markets, Patrick?
You should always expect a correction. You don't know when they're going to come, so you have to be ready for it. I don't think multiples are so frothy that equities can't move higher. I expect equities to move higher by year end. I think the leaders of the market continue to move forward. So people worry about valuations of the Magnificent Seven. Mm-hmm. 6 of the 7 for me look very attractive. Tesla, I can't get my head around the valuations there, but the dominant market positions, the free cash flow, the profit margins, defendability of those margins, they demand premium multiples. And I think the multiples they're trading at are fair, and they are growing, so I expect strength in those to continue. We own Novo Nordisk. The obesity is the new pandemic of the world. So the stocks that people worry about because they've run so far, so fast, still look attractive to me. So there could be correction anytime something's run up so far, but I'm not worried about the multiples they trade at.
But Patrick, when you see, is this a really good setup, I guess, for risk assets? And again, if you look at risk assets, they're not all created equal. So what do you look at right now?
I like risk assets. I came into this year thinking the Fed funds were restrictive, and I don't think it is restrictive anymore. Just the way the economy is holding up, that there's been no real negative feedback from where interest rates are, and it just made sense. The Fed hiked so quickly, there would be repercussions from it, and there hasn't been. So I actually think the Fed's at fairly neutral position right now, and growth is continuing with the Fed funds rate where it is. So as long as there's growth, as long as there's a fully employed American consumer, that drives the economy. And the economy is performing better than I expected coming into this year. We're in a no-landing scenario, in my opinion, and that is a good backdrop. You've got Powell, who can't cut, he says, but he wants to cut. And that means there's a put.
Want him to cut.
Markets want him to cut, but it just wouldn't make sense for him to cut. But everything he says is, I can't cut, But if I need to cut, I'm there. And that's the put option you want to take risk assets. So the Powell put's there. If something does go wrong and that correction happens, or something in the economy forces that correction, I think the Fed's ready.
We had, of course, a story about Richemont today with the change of chief executives. Luxury stocks were kind of darlings, and now they've fallen by quite a lot.
Yeah, we own Hermes, and we've had that for a number of years. We used to own LVMH a year and a half ago. We sold that just as multiples hit 30. But all aspects of the consumer are strong. So a year and a half ago, I was hiding in luxury because the mainstream market had some weakness there potentially. Luxury stocks, there's a real divergence in companies. It's not a tailwind that all luxury is flying right now. Great companies that have the products that people want are doing really well, and companies that are a little bit out of fashion right now are missing. So it's not a tailwind for the whole sector.
Do you expect more consolidation in Europe? And again, valuations have been certainly not at the standards that we've seen in the US. I don't know whether that also leads to consolidation, for example, in banks like Sabadell.
Yeah, so we actually just sold BBVA. It's a stock I've held for a while. I think that they're paying up a little bit too much. I think we've been talking about consolidation in European banks for years and years.
And decades.
It will happen. But yeah, it's not good to be buying somebody who's chasing an acquisition. If there's a merger of equals that just makes sense, you're going to get better pricing power, economies of scale, because it is an overbanked region, Europe. Consolidation will happen. I'm just not a fan of a company chasing an acquisition.
Anything attractive in bonds at the moment? Again,
tips are attractive, yeah. It's compelling. As Jamie Dimon is talking about inflation, I think inflation's with us for a generation. It's just populism is printing new money to pay off old debt, and that's going to create sticky inflation. So a real yield on a tip of 2%, you lock in whatever inflation is and get an extra 2% a year. So I like long-duration tips. I still like short-duration corporates because the Fed cuts may not happen, and you're getting a pretty attractive yield at the front end of the curve.
What do you do with the ECB? It would be a shock if they didn't hike in June, right?
Hike? No, yes.
Yeah, cut.
That would be a shock.
I haven't said that for that'd be. I mean, if they don't cut in June,
they've told us they're cutting. They have to cut now. They'd lose credibility because they've just guided everyone that this cut is happening. And the cut makes sense. The economic backdrop's not as strong in Europe. They want a relative loosening versus the U.S. because the U.S. economy is outperforming. So, yeah, the cut's happening from the ECB.
What happens after the cut? So I misspoke because actually the danger is that they cut and then they have to hike.
Yeah,
If inflation's too fast.
It's possibility. I think they've thought it through. The ECB actually does have a restrictive rate, in my opinion, despite being lower than the Fed. Just the European economy's got different dynamics, and that cut gets it down more to neutral. I don't think, unless we have a real global upsurge in growth, that they'll have to do an about-turn on that.
So what happens for attractiveness of European economy? We're also having the EU elections, and I don't know whether we're underestimating some of the policies that could actually come out of that. Yeah,
there's elections everywhere this year. I think it's 65% of the population's got an election in 2024. So politics is always a lot of headline-grabbing things, and then it's a bit of it doesn't matter as much as you worry most of the time, and I hope that's the case. I'm not really putting much of a wild card from European politics. I think it's steady as you go, and not everything's great in European politics, but I don't think we're going to get any shocks from that.
Okay, Patrick, as always, thank you so much for joining us. Patrick Armstrong, their Chief Investment Officer at Plurimi Wealth. Now, nickel rallying the most in a month as unrest in New Caledonia raises concerns about further disruption to supplies from the French territory. Now, the South Pacific archipelago, which was the world's third biggest producer of the EV battery metal last year, has been racked by violent riots this week due to a change in voting rules. Now, that's disrupted output from French miner Eramet, which is running its local unit at minimum capacity. So we'll have plenty more on that story as well. This is Bloomberg. Now, Georgia's prospects of joining the EU are in jeopardy after the ruling party passed a foreign agent bill. Now, under the law, foreign-funded NGOs and independent media would have to register with the government. Now, the ruling party says the bill is necessary for transparency, but the legislation has triggered massive protests and drawn condemnation from the US, from the EU, and from NATO. Well, we're delighted to be joined by Salome Zourabichvili, the president of Georgia, who has said she will veto the law. Madam President, thank you so much for joining us. Do you think that this law could still be stopped or reversed?
It has been stopped and rejected last year by the same mass demonstrations and protests from our European and foreign American partners. But it has been reintroduced despite the promise by the government that they will never do so. And the way they have introduced it and debated it in the parliament without allowing the opposition really to be present even does not make me hope that they are going to withdraw it. And frankly, by now, it doesn't matter very much whether they withdraw this law or not, because it's the whole picture that is very concerning. All other laws that have been running against the recommendations made by European Union in order for us to be able to apply for opening negotiation of accession. So it's a whole range of, on one side, laws that go against, the absence of laws that are required in the fields where we are supposed to make progress. There is nothing to be done. And the third part is the rhetoric, which is very anti-Western, anti-European, from the top to the bottom of the ruling party, from the honorary president, Ivanishvili, to all the leaders. They speak the same language and call our partners of 30 years that have really built our state and its independence and its development. They're called foreign agents that want to subvert the country, that want to destabilize, that want to overthrow the government. This is a very Russian language. That's Russia. Well, that's what Russia is always saying, and
Madam President,
what it is promising.
So how much concern has there been in your discussions with the US and with the EU, and what does this mean to possibly exceed EU membership?
Well, it means that we are at a very concerning point, that the measures taken and the turn taken by the authorities is not leading us in that direction. And that's why you see these massive demonstrations, up to 200,000 people, and it's a 38th day of demonstrations. And that explains it's this major concern that we might be losing a very important chance, and that chance might not come back in the future. And that would be the responsibility of the government. So there is concern in the society, there is concern among our partners, but we still have a chance because we have close-by elections next October. And I think that after this very clear demonstration, expression of the will of the people on the streets, now we need to have a very clear expression of the will of the people in the elections to confirm that the road they want is a road to Europe and nothing else. So it will be a kind of referendum.
Are you in the more immediate time actually concerned about the increase in violence and the crackdown on protesters?
I am concerned when you have in a row 38 days of demonstrations. While we are very pacific protesters, I have to underline that because they are basically young people, but not only. And there has not been one single car burnt or one shop vandalized during all these demonstrations. So that shows the type of demonstrations we have where people sing and dance. But of course, the violence that is exerted by the police forces and especially by special forces can always escalate. That's why I think that we have to be very careful, that our partners have to put pressure on the authorities to stop the intimidation that we have. People are arrested, including in their homes, because they have been seen and photographed on the demonstrations. So that should be the pressure that we need today from our partners, Europeans and Western partners. And then we will need support to prepare for the elections.
Madam President, you've called this this law a Russian law. Does this go to the fact that basically it's a battle in Georgia over who to align with, Russia or the West?
There is no battle in Georgia. Georgia, you have to remember, is a country that has been fighting for its independence from many countries over the centuries, but from Russia still since 1801. So it's very clear for us who is the country that wants to occupy Georgia, and who are our friends and partners that have been supporting Georgia's independence and development. And Georgia's independence is directly today for 80% of the population, and that explains the high numbers linked to Georgia's independence. We know that those two cannot be delinked. That's why such a reaction, and that's why such a strong support to our European future.
But why do you think the founder of the ruling party actually wants this law?
That you have to ask to them. It doesn't make sense. They might even have won the elections if they had not presented this law. And because their speech until now, their narrative, until even last December, despite some measures that were not very comprehensible, their narrative in December was that we are going toward the European Union. We are the ones that made that possible. And suddenly we have the narrative that you can hear in the speech of the president of the party, Ivanishvili, on 29th of April, which is a war on our Western and European partners.
Madam President, thank you so much for joining us today. That was Salome Zourabichvili, thank you, the president of Georgia there. Now, a reminder of the Georgian ruling party's response. It says a law is needed to expose the funding of non-governmental organizations and media. Now, a couple of news that we need to bring you up to date with. This is the Chinese central bank, PBOC, set up a 300 billion yuan of relending scheme for public housing. So this is a number of things that policymakers in China are trying to put in place, actually to support some of the sectors most in need. Earlier, China announced its most drastic move yet to shore up the country's struggling property market, removing the floor on mortgage rates and encouraging local governments to buy properties to convert them into affordable housing. Coming up, Jamie Dimon tells us the U.S. must stay engaged with China. More from our interview with the JP Morgan chief executive. That's next, and this is Bloomberg. The JP Morgan chief executive, Jamie Dimon, told us the U.S. has to stay engaged with China. Now, speaking to me at the bank's Global Markets Conference in Paris, Dimon says Washington and Beijing have common interests and are not natural enemies.
So the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And, it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that. And put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But the engagement is the right thing to do. China is not a natural enemy of the United States. They have a lot of their own problems. So, to me, we can work together as best we can. And then we have common interests: climate, anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually, given all of this volatility?
They're cautious. I mean, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. And remember, we bank, I've got the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I put Hong Kong in that bucket too. We look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know.
Why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place?
So if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation. I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend spend more time in trade. It means NATO. It means that Russia should not win in Ukraine, because if they do, I think it can tear asunder this Western world.
I know you've ruled out being Treasury Secretary.
Yeah.
Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving or doing anything else. So.
Well, that was the JP Morgan Chief Executive, Jamie Dimon, speaking to us at the Lenders Global Market Summit in Paris. Now, Richemont has named Nicolas Boss as its new chief executive. He'll start in the role next month. The management reshuffle will actually see the chairman and controlling shareholder, Johan Rupert, give up some of his management duties. Now, the changes come as the luxury conglomerate reported annual profit and sales that actually met expectations. Now, on the back of that, you can see Richemont gaining 4.7%. Coming up, as the ECB debates how quickly to lower rates, we speak exclusively to Eurogroup President Paschal Donohoe. That's next, and this is Bloomberg. Rich sentiment, of course, dampened after Fed officials warn interest rates should stay higher for longer, pausing another record-breaking stock rally. Now, Chinese retail sales show their slowest rate of growth in a year, while Beijing gives its ailing property sector a boost, easing mortgage lending. Plus, JP Morgan Chief Executive Jamie Dimon tells us he's still more worried about inflation than markets appear to be. Well, good morning, everyone. Welcome to The Pulse. Happy Friday. We've made it to Friday. I'm Francine Lacqua here in London. Now, the European Central Bank's Isabel Schnabel has come out against back-to-back interest rate cuts in June and July, saying that the second rate cut does not seem warranted on current data. Now, as they debate how quickly to lower rates, officials are zeroing in on wage growth, which has remained rapid, as well as geopolitical threats like the conflict in the Middle East. Now, to discuss all of this, I'm delighted to be joined for an exclusive interview by the Eurogroup President and Irish Minister for Public Expenditure, Paschal Donohoe. Minister, thank you so much, as always.
Good morning, Francine.
For joining us. I mean, you understand the nuances of inflation, frankly, more than most. How difficult, given the underlying pressures of fragmentations, of kind of shifting AI, is it to reach the 2% target?
It is complex, but I do believe there's a path available for that to happen. If you look at where we are at the moment, last year, we would have seen inflation in the euro area at just above 3%. I believe across this year we'll see it at around 2.5%. And if I look at next year on current economic forecasts from, let's say, the European Commission, I believe it would be close to 2%. So I do believe there's a path towards achieving that. Fiscal policy within the euro area is not contributing to where we are with inflationary challenges at the moment. And I think the approach the ECB have at the moment is frankly the right one. It's a complex, changing world. Let's look at the data every month, every quarter, and see where we are then.
Of course, I know the ECB is independent. I know you're not also a markets guy. Mm-hmm. But actually, when you look at once there's a cut, does it make a difference if we continue cutting to how people think about Europe, how people think and connect actually with politicians?
I think it will make a difference. But as against that, what also makes a very significant difference, which was a real risk in recent years, that we saw the risk of inflation becoming embedded into our economies and our politics, with all of the impact on the cost of living for households, for businesses, and in turn how they view politics. That could have been a huge challenge. I believe we've been successful in navigating that challenge. And as we get to a point that inflation is at a low and a stable rate, the ECB will then make their decisions.
Why is it so difficult in Europe to have a capital markets union? I know it's difficult to break down some of the barriers. We understand that there are some members that say, look, we'll go at it alone if we don't have a wider resolution.
Sure. So we are making progress in capital markets. Capital markets are part of the single market. They have evolved. But I think the premise of your question is a fair one. We haven't made the kind of progress on capital markets that we have in other aspects of the single market. Why? The reason for that is these are areas of important national sensitivity. It's important to economies at a national level. But all that being said, I believe there is a renewed high-level political focus on doing this. It's been led by the Eurogroup, and the reason for this, as you will well know and your viewers will know, is we are trying to normalise borrowing, normalise budget policy, and at the same time we need to fund huge changes. And we've hundreds of billions of savings within the euro area and European Union that could be used to really help with this. And this is why on Monday night, for example, finance ministers of the European Union get engaged on specific areas that we can make progress on.
What do you worry about Europe at this juncture? Do we need more integration? We also heard our editor-in-chief actually spoke to President Macron Monday, and he wasn't against cross-border consolidation. But if Europe doesn't integrate more, is there a chance of it dissolving?
So I think we have proven again and again that any risk of dissolution is completely overstated, and the European Union have demonstrated its political resilience and its solidarity in recent decades so strongly. So I believe the European Union is really here to stay. Yep. But to deal with your question then regarding what is a risk that I would be concerned about, it is really the risk of our medium-term economic performance. We're getting inflation down, growth is back, we've avoided a recession, which is a huge economic achievement. But I want to see, as we get inflation down, I want to see the euro area and Europe grow quicker. I believe we can do it, but we need to take further steps to make that happen. And that's why your earlier question regarding capital markets is so important.
We have big elections, of course, the European. I mean, we have big elections everywhere. But actually, local elections in certain parts of Ireland. There are, of course, the European elections. I mean, what are people voting on? Do you worry that it's again a bit of a mismatch, and so actually the polls are not right, that we could see surprises?
So I think we're in a just as you said, there's big elections happening everywhere at the moment. I think there is a trend in recent elections, which is the degree of volatility that can happen during campaigns and then at the end of that in the election result. From an Irish perspective, the issues that voters think about, I think, are in common with what's happening across Europe. Housing, cost of living, pressure on public services, how we can look after ourselves in a world that's really changing, are the kind of issues that people bring up with me on the doorstep in Dublin Central, and I know across Europe, they're the issues that my finance minister colleagues are grappling with too.
I mean, how would you look at immigration? This is one of, I guess, the most contentious or divisive issues across European and maybe world politics.
And of course, it has been a significant factor in recent political debate, and that is explained by the change that has happened in migration. We have the largest movement of people across Europe since World War II. We, as always, need to realise that those who are coming to countries such as Ireland, who are seeking refuge, are coming from dire humanitarian consequences and conditions in so many cases, and we have to look after them in a way that is compassionate and fair, which is what, in Ireland, we are trying and working to do.
I think there's a recent opinion poll suggesting that Fine Gael are at very close levels to Sinn Féin. Do you ever foresee a possible coalition?
Absolutely not. I do not believe that will happen. The poll that you refer to is one that shows Fine Gael growing in support due to the new leadership of our Taoiseach, Simon Harris. But it shows a massive slide in Sinn Féin support now that's taken place over the last year. I believe that will continue. And I believe coming into the general election in Ireland, which will happen sometime next year, I believe it will happen at the end of our parliamentary term next year. I believe that this government will be able to put forward a great case for three independent political parties who will be making the case for the government to be re-elected.
How much anxiousness is there in Europe if Donald Trump gets into the White House on a defence level, but also economically with tariffs?
Sure, it's going to have very significant consequences. Who the American people want to be their president is obviously a matter only for America and for them to decide. But my big lesson over the last number of years is the need for Europe to deepen its economic ability to stand on its own 2 feet. That is why we've taken the actions that we have regarding supporting the people of Ukraine against the terrible invasion that they are grappling with. And it's also why, for example, the decisions on capital markets and how we structure them are really important. The friendship, the relationship that we have with the United States and Europe, I believe, is extremely important and valuable. However, we also need to look at how we can ensure that Europe economically is stronger within a global economy.
So do you believe trade deals will depend on political alignment more than they ever have?
I think political alignment has always been a very big feature of trade deals and trade policy. And I think the big lesson at the moment from some of the debates that we're seeing taking place on economic policy is it reminds me how much politics matters. Being at the IMF World Bank meetings there a few weeks ago, I was struck by how many of the analysis said that decisions that politicians make can really matter in economics. And I think we can see why that is at the moment, and when it comes to the conduct of trade policy in the future, how we can ensure that they are fair, and how we can ensure, particularly here in Europe, that trade policy is rules-based, is multilateral, but is also fair to the European Union, I think is the big terrain of trade policy debates in the years ahead.
Thank you so much for joining us.
Thank you, Francine. Thank you very much.
In London, that was the Eurogroup president, of course, and Irish Minister for Public Expenditure, Paschal Donohoe. Now, coming up, but we talked to Daniel Pinto, the chairman and chief executive of Stanhope Capital. He joins us to discuss Fed, inflation, and the widening gap between Europe and the U.S. This is Bloomberg. Now, markets now just pricing in 2 rate cuts from the Fed this year. Several officials at the central bank, including Loretta Mester, John Williams, and Thomas Barkin, have all said it may take longer for inflation to actually reach their 2% target. Now, the resilience of the U.S. economy has surprised some, and it comes as the economic and financial gap with Europe continues to widen. Now, GDP growth and productivity levels are now much further ahead in the U.S., something which my next guest says is a once-in-a-generation phenomenon. Well, Daniel Pinto is chairman and chief executive of Stanhope Capital, an asset management firm he started in 2004 with more than $41 billion of assets under management. So, Daniel, as always, thank you so much for joining us, and welcome back to The Pulse. When you look at what you're expecting from the Fed, I mean, it's a little bit of an outlier call. You're expecting the Fed to cut quicker than the market is pricing. Would they cut because there's a slowdown or because of inflation is under control?
My first comment, Francine, is that who would have said that watching central bankers would have become as exciting as watching a thriller? We listen to each and every word. Look, my sense is that the U.S. economy is slowing down. It's still doing okay, but it is slowing down. Let's remember that the market was expecting 2.5% GDP growth for Q1. It came out at 1.6%. So it is slowing down. You have PMIs coming down, which is a sure sign that there is a slowdown. You have unemployment picking up a bit, still very low, but picking up a bit. And 2 more things, which in my view are very important. The first one is that saving rates in America have collapsed. Post-COVID, Americans had plenty of savings, and that sustained the economy for the last 2 years. Right now, they have 3.5% of savings, which is the lowest point in the last 10 or 15 years. Which basically means that you no longer have this buffer in the form of the domestic consumer to support economic growth in the next few months. And I think the Fed knows that, and the Fed will cut rate, in my opinion, in September, probably twice.
So, Daniel, we all spoke to Jamie Dimon yesterday, and he was saying, look, it's the market makes it a given that we have a slowdown, that is a soft landing, and that's not a given. But is there the worst case scenario is that inflation actually stays up, and that these indicators come down? So what does the Fed choose then, and what kind of economy are we left with?
I think the Fed will be under pressure for another reason, which is that let's remember that a year ago we had a banking crisis in the US. Yeah. We are not hearing anything about it anymore, but you have dozens of small regional banks in America that are exposed to real estate, are writing off loans, and the higher for longer phenomenon is having a direct impact on this second tier of the banking sector in America. And I think that the Fed will, in addition to the slowdown that I described, the Fed will very much be aware that if they keep rates at this high level, they may have another banking crisis on their hands. Which obviously they would like to avoid.
But there's also a question of why the Fed is not pushing back against some of the market exuberance that we've seen. Do you see this as being problematic?
I don't think it is problematic. I mean, there is some exuberance in the market, but I don't think that we are in bubble territory. If you look at stocks in America, they are trading on multiples of about 20 times, which is higher than the average. But if you strip out the technology sector and the Magnificent Seven, the valuation levels in the US are in line with the average of the last 25 years. You don't have a bubble in the equity market in the US. I don't believe so.
Daniel, I know there are some charts actually that you look at, which we love showing because it gives us a glimpse into kind of what kind of template you look at to look at growth and valuations. There's a mismatch between the U.S. and Europe. I mean, if you're expecting actually the U.S. to slow down not significantly, but enough to pull forward expectations of a cut, where do you see the biggest play? Do you get into European stocks?
So European stocks are cheap at the moment as compared to the US. In fact, you are at the point where the discount between Europe and the US is at its highest in the last probably 20 years. You basically have a 35% discount between the valuation of European stocks and the valuation of US stocks. It makes a certain segments of the European equity markets attractive. And it could be, and we've seen that in the last few months, that for a short period of time, European equities could outperform the US. But for any long-term investor, I would recommend having the majority of their exposure to US stocks for reasons that have to do both with the US economy that has decoupled from the European economy and as a result as well of market dynamics which are much better in the US than in Europe. So short-term, yes, European equity is attractive. Long term, I think investors should keep the vast majority of their equity exposure into the US.
I mean, this is actually the chart of the day that we're just showing, one of the charts that you're looking at. I mean, does this explain why certain companies, I mean, we were talking with actually the chief executive of Total Energy just on Tuesday, but other companies would look at a listing in the US, and does that even make sense for big European companies?
They would, and it should worry a lot of politicians in Europe. When you hear Total Energy, which is kind of a national champion for France, saying we would like to move to list in the US, it is a shock. When you hear Shell saying the same thing, it is a shock. And the reason why they are saying that is very simple. The capital markets in the US are so much deeper that they get better valuations. You cannot blame them for saying, I'm working for my shareholders, and with shareholders in mind, our interest is to list in the US. And the reason why the capital markets are so much deeper is that they have a pension system that drives savings into the real economy, whereas in Europe, in most countries, we have a pension system that is still public and is not driving savings into the productive economy. And that's a major issue. Just take the case of the UK. 25 years ago, pension funds in the UK were investing 45% of their portfolios into UK equities. Now it is 4%, 5%. And that has a massive impact on appetite for equities overall, and therefore valuations. And that is something that CEOs across the UK and across Europe have in mind.
Daniel, I have so much more to ask you because that goes back to some of the mansion house reforms that we were talking last time you were on. But I think historically it's also quite difficult to have a headquarter in Europe and list in the US successfully. So Daniel Pinto stays with us, and we'll have plenty more on this next. This is Bloomberg. Well, still with us, Daniel Pinto, Chairman and Chief Executive of Stanhope Capital. Daniel, thank you so much for sticking around. Now, we were talking a little bit before about the change or the difference in capital markets between the US and Europe, especially in the UK. I mean, what should be the priorities of politicians and policymakers in Europe to be more competitive and keep the good companies here?
So most of the savings in Europe are in the hands of insurance companies and pension funds. And right now, this capital is locked up, unable to deploy itself in private equity, public equities, etc. And that's a major difference with what's going on in the US. And I think it is hampering not just valuations, but the capacity of these companies to invest. And that's really not just an economic issue, it's a political issue as well. So I think the priority for politicians right now should be to address this very issue. Make sure that insurance companies have more leeway to invest in private equity and public equity. Make sure that pension funds are not just focused on investing in bonds, which are not necessarily helping the economy at large, but investing more in small and mid-cap companies and in large companies. That should be the priority.
Yeah, it's not easy because it goes really to the heart of like risk taking. But talk to me a little bit about what you're seeing in the pipeline. Are there more IPOs or is there more M&A deal? Is it waking up?
So clearly, after 18 months, 2 years of pretty much a standstill in the IPO market.
Sleeping Beauty.
Absolutely. And private equity funds not doing much, frankly. What you see now is private equity funds being very keen to deploy more and sellers more open to selling. So you'll see deal flow picking up, which is great news. The IPO market is slowly opening up, more in the US than in Europe. I was pleased to see that the Chinese company Shine is contemplating doing an IPO in London as opposed to the US. It's a good sign, but sadly, I think we have to do not a done deal, and we need to do much, much more to make London more attractive. But clearly, the trend is going in the right direction in terms of IPOs and deals.
I mean, does it make a difference who comes into power in terms of businesses right now, or do you see both parties?
In the UK?
In the UK, pretty much in the middle.
I think the two sides want to reform London and the city in general. The question is whether they've been talking about it for a while. Not much has happened. The question is whether any new government, probably from Labour, would actually implement the reforms that are absolutely necessary. I hope they will. They seem to be more market-friendly than people expected. Let's see.
What do you do with gold right now? So it's a play against everything, but it's also, I guess, there's movements maybe from other countries to sell treasuries and buy gold.
So there is something structural happening in the gold market, but beyond the gold market, in trade in general and currencies in general. You've seen the price of gold going up dramatically over the last, I would say, 12 months as a result of central banks buying more and more gold. And the biggest buyers of gold have been probably the Chinese. And the reason why they are buying more gold is that they don't want to be in the position of the Russian central bank, which, given what was going on in Ukraine, ended up being sanctioned and ended up having their reserves frozen by the US. The Chinese have trillions of reserves. The last thing they want is to hear one morning that the Federal Reserve had decided to block this money. So they buy more and more gold. The Indian central bank is doing the same, and that is what's sustaining the gold market. Beyond that, I think we should read behind the rise of gold an increasing risk of currency wars and an increasing risk of trade wars.
Is that your biggest
Sanctions,
concern?
Tariffs. That would be my biggest concern for the next 12, 18 months. You heard President Biden announcing last week very high tariffs on electric vehicles, 100% tariffs on microchips made in China. And then you heard Trump basically saying, 100% is not enough, it should be 200%. So that rhetoric is giving you the direction of travel. Direction of travel is more and more trade tension. And trade tension and tariffs are a very, very bad thing for everyone. We should be very careful about that.
And possibly inflationary. Danielle, thank you so much, as always, for joining us. Danielle Pinto there, the Chairman and Chief Executive of Stanhope Capital. Now, Bloomberg Brief is up next. Also, a reminder, China this morning unveiled some pretty broad rescue packages to try and shore up their housing market. This is Bloomberg.